Good afternoon, ladies and gentlemen. Robert Rayburn here from Life Pro Asset Management. I hope that everyone's having a fantastic week so far and is looking forward to the weekend. Certainly the week has blown by quite rapidly. And, I know here at the office, we were busy with so many things as earnings crank up across all of our different investments. Second, we had a conference here with many of our advisors that are in charge of meeting with clients one-on-one, and certainly it was great to catch up with many of those advisors. So for those who are on the call, thank you for attending that. And then thirdly, we're joined again by Tim Devlin. And he's enjoying an incredible promotion here. Look at that office behind him, and I'm certainly jealous. But no, all joking aside, Tim, it's great to have you back.
It's great to be here. Great to have the office as well for the next 20 minutes.
Absolutely. And for those who don't know, that is our founder's office, Bill Zimmerman, and he's been away for the last few weeks, but we certainly look forward to when he will be back in the office. But let's go ahead and get started. Tim, can you see my screen?
I can.
Awesome. Well, this week is all about securing the base, ladies and gentlemen. We had a nice recovery over the last few weeks, and really week over week, we've traded flat. We rose a little bit at the end of last week. We gave some back, then we got some back again yesterday. And that's normal. That's normal as you sort of trade off the bottom, and we should expect that to continue as we consolidate some recent gains before moving the next leg higher. So what we want to do is really kind of talk about how that daily noise of the market has started to decrease. We're seeing some more normal trading conditions begin to envelop the market. That's a healthy thing, by the way, as we get away from this whole work from home trade versus reopen trade. We're now going back to, hey, are these companies healthy? Are they growing? And can they resume their move upward in terms of their overall value? The big message from this week is the economic recovery continues to advance across the US, regardless of sort of news stories that we hear. Secondly, great businesses benefit from economic recoveries. There's been a huge focus on the junk. Well, guess what? Now we're starting to refocus our attention to quality businesses that can grow in any type of environment. Because guess what? When the economy does well, it's not just junk companies that make more money, it's also great companies that make more money. Secondly, breadth remains remarkably strong across the stock market. So even on a day like today or yesterday, what we're seeing, especially yesterday, is a strong upward to downward moves in individual shares. Today, the headlines look weak, but we're actually seeing some underlying strength underneath the hood of the market. Thirdly, I want to talk real briefly about some of the headlines today about sort of the capital gains tax rate. This is a great example where a headline hit, panicked a lot of people, and then the details are really about sort of that top 0.1% getting hit with a higher capital gains rate that typically, if we look historically speaking, doesn't really affect stock market performance at all. So just a classic example of a headline hits and then the details come out and it's sort of the opposite of the initial fears. And then lastly, the credit markets continue to act fantastic. And this is where you would see the trouble percolate before anything else. And when we look across the credit markets, things look so healthy, and we want to see that. That is the foundation, the underpinnings of the US economy. Real quick here on performance, as we said here at the beginning, really not a whole lot of change. Now, I do have to preface, I just realized here that should say April 21st, not April 8th. But as of April 21st, down about 4.9%. We were down about 4% last week. So we've really sort of just traded flat, and the market kind of traded flat as well. So again, we've recovered off the lows. The next leg of the recovery to close that performance gap in 2021, so that we can resume our long-term outperformance, which we see here over 1 year, up close to 100%, which is pretty remarkable considering last year at this time we had already had a nice vicious recovery since the March of 2020 lows. So again, those year-over-year comparisons are going to get tougher, and we should see those numbers come down because of the comparisons. But the fact that we're still up 100% after a month of recovery a year ago today is quite remarkable. And then since inception, up 211%. In other words, ladies and gentlemen, we've been able to generate outperformance versus the market of 125% after fees. So something we're definitely proud of, but we do expect this performance gap to close again as we resume some more normal trading conditions in the overall market. Now, this was a chart that Tim put together for us. So Tim, do you want to walk us through what we're looking at here right now?
Yeah, so what we're looking at is we're comparing the recoveries from the 2009 recovery after the financial crisis, and then the 2020 recovery after the COVID sell-off. And what we can see is, if you look at this chart, it's very similar in nature. You can almost see tick by tick in some cases, it's going up into the right. But what you can also see is on the chart on the top there, what happened after that recovery, 392 days, which is the same length as the recovery from 2020. And then what happened 5 years later for that 2009 recovery, and what happened to today. So what we want to look at is what happened in both scenarios, but also what happened after that initial recovery. What does history tell us, occurred back in 2009?
Yeah, I mean, the big message here, Tim, is that we get a lot of questions inbound from clients that are like, listen, your performance has been great, but I feel like I missed the recovery. So if I invest now, I'm going to lose money. And what we see in history, and it's not just the 2009 recovery, it's most recoveries after recession, is that first year does appear really strong. Why? Because you're coming off a low. You're coming off a lower base. So mathematically speaking, you're going to have these really attractive performance numbers, just the market as a whole, forget our strategy. But don't let that distract you, because what we often see is that that's usually the first or second innings of the recovery. Recoveries don't last 1 year or 2 years. Every once in a while you get this what's called a double dip, but that really only happened in the 1970s and in the 1930s. What we see here, the message is that yes, 2009 had a huge year off the bottom after the global financial crisis. But for those investors that had missed the first 75% of the recovery and then said, you know what, now I'm going to invest, they still realized 74% growth over the next 5 years after missing the first 392 days. And if we play that all the way through to today, they're up 250.61%. So it's one of those classic cases of it's better late than never. And yes, if you had not invested in the first 392 days of this recovery, you missed 86%, but that's okay because we're still in the second year of the recovery. And if we continue to follow this path of 2009, certainly the forward path continues to look quite attractive and the setup appears attractive for the overall stock market.
Now, Rob, one of the things I noticed on this chart is as we're getting closer to today, that difference between the 2009 and 2020 recovery is starting to widen. What's a little bit different about this recovery compared to the 2009 that is maybe letting it recover better, faster?
Yeah, I would say the reason why you see this gap here is because the big difference between 2009 and today is the level of quantitative easing, or otherwise known as money printing, taking place at the Federal Reserve is astronomically greater today than it was back then. And we're getting a huge fiscal response from the US government. Now, regardless of where you stand on in the political aisle, right wing, left wing, center, it doesn't matter as it relates to the stock market. What we need to pay attention to are what do the inputs have, what are the impact of those inputs on the output of the stock market. And historically, when you increase government spending, at least for the first couple of years, that is a positive for the stock market. If you remember, after 2009, we had the debt ceiling debacle where the US government would not, was having this debate of raising the debt ceiling. And there was no real fiscal response after the global financial crisis. We had the initial TARP program of $700 billion in spending, but then after that, really at the end of the day, the US government actually started to pull back spending. So that acted as a headwind on top line growth. This time around, you're getting all cylinders fueling the recovery. You have the initial recovery itself, because we're just reopening the economy. Two, we have huge monetary support from the Federal Reserve in the form of money printing and 0% interest rates. And three, we have the fiscal response from the US government in the form of $2 trillion of fiscal spending. Again, we will have to pay the bill eventually, but that's a few years down the road. Real quick here, in terms of trading conditions, ladies and gentlemen, breadth remains remarkably strong. Even here at these upward levels of the stock market, S&P 500, what we see is on a day like yesterday, the number of advancing stocks up 5.8 versus the number of stocks that were down. So that ratio of 5.8 to 1, that does not tend to happen ahead of deep stock market corrections. What you see here is during deep corrections like we had in 2010, is you have a number of solid distribution days. In other words, reverse ratio, where the number of sellers outnumbering gainers is in that 5 or 6 to 1 ratio. We just don't see that type of behavior this time around. So breadth remains remarkably strong. And again, we're continuing to see breadth expand as the market advances. Does that mean we can't have a couple of weekdays? Of course not. We're always, on any given day, the market could go up, could go down. That's less important. What's more important is, are we seeing broad participation in terms of stock market advances? And the answer is yes. And more importantly for us as investors, for our clients that are in our strategies, breadth is beginning what we call that reverse expansion. So it expanded into those stocks that had not participated in the recovery over the first year. In other words, those junk stocks, that was funded by selling some of those secular growth stocks. Now we're seeing that money reverse back into some of those secular growth areas. That's a good thing. That's a healthy thing. We want to see that. We talked about this last week. Wall Street remains bearish. And the bottom line here is that whenever we see strategists forecast for the S&P 500, their year-end price targets below where the stock market is trading at, versus in other environments where those price targets are above where the stock market is trading at, the forward performance, believe it or not, ladies and gentlemen, is actually better for the stock market when Wall Street is bearish versus bullish. And we can see that here, that if we look at 125 days outbound versus where those price targets are below where the market is trading at, it's a 5.9% growth rate versus 2.4% when Wall Street is bullish.
So Rob, why is it that, Wall Street, the group with the largest amount of capital, whenever they're bearish, why is that good? Wouldn't it make more sense to think, hey, if the group with all the money thinks it's going to go down, the market's not going to go up?
Great question. And the answer to that is simple. Wall Street strategists work on what we call the sell side of the business. So that's the investment banks. Those are the banks that facilitate the transactions of hedge funds, of mutual funds, SMA products, etc. So they're not the ones that are actually driving the trade flow in the market. It's the hedge funds, it's the mutual funds, it's the pension funds. They're the ones that are driving money flow. And a lot of times these investors are noticing something that the strategists are not. They're noticing certain things that are taking place in the recovery that you just can't put on an Excel sheet. It's what we call that qualitative data versus the quantitative data. And that's the stuff that it's hard to quantify, it's hard to model, but investors are observing it, they're seeing it, and they're making bets on it. And that's really at the end of the day where Wall Street strategists in many cases have to catch up to the numbers. We see that in earnings as well. We know that, for example, let's say a company like Lululemon, just kind of using it as an example. We see that its brand is gaining traction amongst a certain cohort of the population. We know that we can't necessarily model it, but we see it and we feel it, that it's hitting an inflection point. We're going to buy the stock and increase the multiple on its valuation. Wall Street strategists at then, or analysts at some point, will have to catch up and revise those numbers higher. So again, a lot of the times the market is sniffing something out before you can actually encode it on an Excel sheet. So again, what we see here is earnings coming in far above expectations. So far in this quarter, 73% of companies are beating sales expectations. 84% of companies are beating earnings expectations. We had an advisor ask us yesterday, how do earnings play into our overall portfolio strategy? And they're at the very core of what we do. They're the mother's milk of Wall Street. In other words, when we think of a stock price, it is a reflection of how much money it makes. And so we want to focus on companies that as things get better, they have a business model where every incremental dollar of sales is driving earnings and cash flow to drive that stock price higher. So again, the big message though for clients and advisors on the call today is that when earnings and sales are accelerating to the upside, it just doesn't lend to a whole lot of evidence that the recovery is sputtering out or that we have elevated recession risk. We simply don't. And we want to see that in a recovery.
And Rob, one of the things this reminds me of is something you talk to me about a lot. A lot of investors out there are going to look at what's called a PE ratio when they look at the price and the earnings. But one of the things you often talk to me about is you don't want to solely look at the price. We want to look at the earnings. Are the earnings growing? Because that changes the ratio just as much as the price does.
Yeah, and it's tricky, Tim, because a big mistake we often see in year one and year two of the recovery is people are shell shocked from the prior sell-off, from the prior recession. And then they're going to look at these PE multiples and you say, oh my God, the market's trading at 30 times or 25 times, or this stock is trading at 35 times. We're going to remember the anticipation of the earnings recovery happens before the earnings recovery itself. So let's say you have a stock that's trading at $20 and then COVID hits and it goes and it trades down to 10. Okay, so that stock is now trading 50% lower. Now the earnings from that is going to trail the expectation of the hit to earnings. So in other words, in March of last year, let's say a company again like Lululemon or McDonald's, we know that their sales are going to get hit. So the stock sells off. The earnings hit then will happen next quarter and the quarter beyond that. But the stock starts to recover. So earnings trail the recovery. That's what we call the multiple expansion of year one. So the first year of a stock market recovery is called multiple expansion. The expectation that in the future that the recovery is going to drive earnings upward. Year two of the recovery is the earnings recovery itself. Is it better or worse than expected? So we want to focus on companies that are not just recovering in earnings, but are doing better than we actually expected. And so that's really what our framework is around this year. Last year is about multiple expansion. This year, it's about that earnings recovery. And we do anticipate some changes in the portfolio here over the next few weeks. One area that we're increasingly liking is energy. And it sounds bizarre, but believe it or not, and we're going to go through this chart here in a second, the level of energy consumption is starting to surpass 2019 levels. And no one would believe that if you think of everything we talk about with green energy and everything else. So traditional energy consumption is starting to surpass 2019 levels. E&O production has not kept up. Refined energy production has not kept up. So there's going to be a real gap in terms of the level of demand versus supply that's available out there. Energy's pulled back here over the last 3 weeks. Could be an attractive entry point. Not promising anything yet. We're still doing our homework, but something that we're looking at here over the next few weeks. Real quick here, COVID cases continue to fall. We're not going to get into the details of why or when or where, but at the end of the day, in the US, COVID cases are falling. That does underpin the underlying recovery in the US because it keeps things open. That's the big message here. And we talked about this just a second ago. This is showing US product demand in terms of energy products. What we can see here is propane consumption is actually above 2019 levels, and total energy product consumption is now approaching 2019 levels. The market is not pricing this in. The bottom line here is that rising economic activity leads to greater oil demand. So when we see lines shooting upward and to the right like this, it's not suggestive of a failing recovery. We want to take advantage of that, whether that's in the energy space or just the market as a whole in terms of our level of confidence of the economic recovery. Backing this view up, jobless claims continue to fall. Now, we still have a long way to go, about 520,000 or 530,000, 547,000 this week. We want to get back down to that 200 to 300,000 number that we saw last year, but we're going in the right direction. That's a good thing. One caveat to all of this is that China growth is beginning to slow a little bit. That doesn't really impact a lot of US companies per se, outside of maybe like some of your multinationals, but it does potentially impact the interest rate environment. We've had some concerns of rising interest rates as of late. If China begins to slow, they're the biggest contributor to overall global growth. So if global growth starts to plateau, we should see interest rates start to be contained. And that's a good thing as it relates to the stocks that we own, because a lot of our growth takes place in the future, and that should stabilize the overall multiples of our stock valuations. And then lastly, credit markets remain healthy. We wanted to talk about this. We focus on it every week. It's the underpinnings of our risk analysis when we look across the world. We always focus on high yield bond spreads and how those are low, but I wanted to show viewers this week that this is true across every sector as well: energy, industrials, consumer discretionary, materials, financials being the most important because that's where the banks are. They're the suppliers of capital. We are seeing improvement in credit across the board. Again, this just does not happen ahead of recessions. So overall, Tim, as COVID cases continue to fall and we're continuing to see those rising economic activity levels, so that second derivative data continues to improve, that should underpin the economic recovery. Important to remember that great companies do well during recoveries. The credit markets remain healthy, so solid, healthy foundation. And just very, very important, because we're in year 2 of the recovery, ladies and gentlemen, corporate earnings are coming in far above expectations. So overall, this should continue to paint a nice picture for the stock market in 2021. Year 2 of the recovery is always a little bit more challenging than year 1, but stock selection is going to be key. And every once in a while, if things get overbought, we need to take a little bit of money off the table. You saw that in terms of what we did with Ethereum last week. We reduced our position by half. We still love Ethereum. We think it's going much higher, but very overbought in the short term. So we took a little bit of money off the table there. We did add to our Unity software position this week. We love the company. We think that they are at the center of the video game economy. And so again, when we see great names that are being sold off, we want to add to those positions. But overall, thank you again to everyone for your business, for your loyalty, for your questions that we get throughout the week. We love those questions. And if you have any more questions, please feel free to reach out to your advisors, or you can reach us at 888-543-3776. Tim, thank you as usual. And everyone, thank you. And have a great week.